Hello everyone and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're talking about short strangles. So we finished up our discussion for the meantime of the Greeks. So we talked about delta, gamma, theta. Now we're going to talk more about some strategies. So a short strangle is a high probability trade that you'll see us doing here all the time. It's a premium collecting or premium selling trade. So we're all about it here in high implied volatility environments. So what we're going to do today is basically break down the concept totally, and we're going to construct it back up. So we're going to talk about why this strangle works and why when we're selling a put and selling a call, the two are basically battling each other throughout the trade. So we'll show that to you visually here. So let's get right into it and discuss what it's made up of. So a short strangle is essentially selling two out of the money options, an out of the money put and an out of the money call, to create a profit zone. So when we're looking here, we can clearly see we've got a short put. And again, a put contract is the option or right to sell 100 shares of stock if someone owns that put. So if we're selling a put, we want the shares of the stock to go up. And that's because if they have the right to sell the shares to me, then I'm going to want that stock price to go up and stay out of the money, because if they can sell their stock in the market for a higher price than they would using my option that I sold them, then that's going to be good for me. I'm going to keep that credit entirely, and it's going to be a profitable trade. So the first aspect of a short strangle is a short put, as you see here. Now we've got the arrow a little further to the left than the actual strike that we sold, and that's because of our break-even point. So break-even is another concept we're going to talk about next week. We're going to break it down totally, but basically it's great to know that when we're selling premium, our break-even price is going to be working for us. So you can see that we actually can profit even if the stock price goes, if it breaches our short strike of the short put right there, and that's because we've collected a credit that we can use to offset that. So again, when I'm selling a put, I want the stock price to go up, and that's because when the stock price is going up, the other party of the contract can sell their shares at a higher price than they can exercising the option I sold to them. So my option would be out of the money or worthless at expiration, and I could keep that credit that I sold it to them for. Now let's take a look at a short call. So we've got the out of the money put on the left side here. And what we would also do to create a strangle is sell an out of the money call. So an out of the money call is just the opposite. If I sell a call above the stock price, which is out of the money for calls, I'm going to want that stock price to go down. So if we review what a call option is, it's basically the right to buy 100 shares of stock at a certain strike. So if my strike is above the stock price right now, it's out of the money. And that's because whoever bought this call can buy their shares actually for a lower price right now. So they would be actually paying a higher price if they exercise that option. So it doesn't make sense, which is why it's out of the money. It has no real intrinsic value. So because of that, I'm going to want that stock price to go down or stay the same, or you can even go up a little bit and breach the strike just like the short put, because I received that credit for the call as well. And that's going to help me overall in the long run. So now we know what a strangle is. It's a short put, a short call, and that creates a profit zone here. So you can see when we add these two together, we've got a profit zone that's created. So we've got a short put where we want the stock price to go up, stay the same, or go down a little bit. And we've got a short call where we want the stock price to go down, stay the same, or go up a little bit. So what we've got here is a zone of profitability. So all this is about is being delta neutral. So a strangle is a delta neutral trade if we place it equally on both sides. And we talked about this when we were talking about delta. So this basically has no directional assumption right now. We're right in the middle of that stock price. So we've got a short call out of the money on the above side, we've got a short put below there, and that basically creates the range that we can be profitable, because at expiration, if these two expire out of the money, we collect and keep the total credit that we collected originally, and that would be our profit. So what we're going to do now is basically walk through what a short strangle might look like through the life cycle of a trade. So if we go to the next slide, what I want you to visualize here is we've got a start and finish line. We've got our short put strike on the left side, our short call strike on the right side, and what I want you to think about is this squiggly line being the stock price. So we're going to start where we've got that neutral trade. There's no bias to any side, so it's a delta neutral to begin with. And when we start out, you can see that the stock price is starting to creep closer to the put side. So what you'll see through the life cycle of the trade is the short put and short call are going to be battling each other constantly throughout the trade because, again, they are different, totally opposite assumptions. When I sell a put, I want the stock to go up. When I sell a call, I want the stock to go down. So since they're battling each other, you're going to see different P&Ls for each of these strikes. But at expiration, we're going to talk about what will happen as long as the option or the stock price stays within the short strikes. So just starting out, you can see if the stock price starts to go towards the put side, what you'll see is a loss on the put side and a gain on the call side. And that's because if I sold a put for a certain level and then the stock price starts to go down, that's going to increase the value of the put. So if I sold the put here and now the value of the put is higher, since I sold the put to begin with, to close the trade I need to buy it back. So if I sell it for $1 and I have to buy it back for $1.50, that's going to be a 50-cent loss there. So what you'll see is when the stock price is going towards the put or testing the put, you're going to see a loss on the put side, but since we want the stock to go down for the call side, you'll see a gain on the call side. Now, as we go through time, you'll see the stock price is going to differentiate and basically swing both ways. So let's say it goes all the way back up and starts testing the call side. Now what you might see is possibly a loss on the call side, but a gain on the put side. And you see I've got 3 dots on the left side and 2 dots on the call side. So as the trade goes along, regardless of where it is, you're probably still going to slowly see a profit overall. So I've got the put profit outweighing the call profit here. And that's because at expiration, as long as this stays between the strikes, we're going to be profitable in the end. So you might see marked losses, which is what these are. All these red dots here throughout the trade life cycle is just a marked loss. Because this stock price is still out of the money or between the 2 strikes on each side, we're going to see a marked loss on maybe one of these, but overall we could probably still see the trade as being profitable as long as there's not a huge spike in implied volatility. So as we're moving along, let's say it swings right back down to the put side. So now we might see that the put side is losing, but the call side is gaining. And since it's outweighing the put side, we can still see an overall profit. And as we creep to the finish line or expiration, as long as the stock price is anywhere within this range, we're going to see profit on both sides and profit in general on the entire trade. So that's really the key here is when you have this trade on, we get this question a lot in support with iron condors or strangles altogether. Whenever one side is being tested, even if it's still out of the money, you might see a loss on one side and a gain on the other. But since we put this trade on as a package, we always like to take it off as a package. So I wouldn't want to be closing my call side when I'm seeing a loss on the put side or vice versa, because now I don't have that neutral range. I have a bias trade then. So I would be going from neutral to bullish or neutral to bearish. So we always like to put our trades on as a package and take them off as a package. So I just wanted to give you this visualization to see how this might act throughout the life cycle of a trade. So let's break this all down and recap what a strangle is here. So essentially, again, a strangle is just the sale of an out-of-the-money put below the stock price with an out-of-the-money call above the stock price, and that's going to give us a net credit since we're selling both options, and it's going to give us a profit range here. So we've got our break-evens noted here, so you'll see that our profit zone is actually going to exceed our strikes, and you'll see that on the Doe platform as well, and that's because it's accounting for the break-even price and the credit that we received when we actually placed the trade. So our first takeaway is that a strangle combines a short put and short call to create a profit zone. So again, since we're selling both of these options, although they'll be battling each other that you might see throughout the life cycle of the trade, as long as they stay out of the money or within our break-even zones, we're going to see a profit at expiration. One key takeaway is that this is an undefined risk trade, and that's because we have a naked call and a naked put. While stocks can only go to 0, so theoretically a naked put is still defined at 0, a naked call is undefined because a stock price can go to anything. It could go from 20 to 80 overnight. There's no cap on the upside in terms of where a stock can go, so this is considered an undefined risk trade. And last but not least, max profit is realized if options are out of the money at expiration. So again, since both of these options are sold out of the money, there's no intrinsic value. And when we're at expiration, the only thing that can be exercised is intrinsic value. So since these options are out of the money, as long as they stay out of the money at expiration, we're going to keep the entire credit we received, and at expiration, if it goes through the actual expiration date, you'll see those options just disappear from your portfolio. And that's because there's no way they can be exercised, so there's no exercise fee or closing fee. They just disappear because they're worthless. So this has been Strangles. Hopefully this was a great visualization for you. On Tuesday, we're actually going to talk about inverted strangles. So we had a viewer, Frank, who wanted to know about inverted strangles. So we're going to take this strangle that we just learned about, and we're going to talk about how it can be inverted over management over time. So it's going to be a great segment on Tuesday. Thank you so much for tuning in. If you have any feedback at all, shoot us an email at support@doe.com, or you can tweet us at DoeTrading, at DoeTraderMike, or at And thanks again. Have a great night.
Hey there, hope you liked this video. Click below to watch more videos, subscribe to our channel, and check out more great research and content.